This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a Mackenzie Investments podcast. I'm your host, Dustin Reed, Chief Fixed Income Strategist at Mackenzie Investments in Toronto. We're a few hours past the Bank of Canada's June decision, and we're going to speak a little bit about that today and what it means for markets and what it means for investors. But maybe before that, a few thoughts just generally on markets and global macro. Obviously continues to be a very significant time in markets from a macro perspective, whether it's equities, fixed income, currencies, commodities, or other asset classes. It certainly has seen a increased amount of volatility and unsureness, I would say, across asset classes. There's a few things driving that. I would say that, we have obviously the very strong labor data coming out of the US as of last week, generally higher rates, not only within the US and Canada to a point, but I would say globally. Concern around valuations from an equities perspective for particularly AI stocks and very growthy names. And obviously the Middle East story, which continues to kind of ping pong a little bit, and oil, although oil has been generally on a downtrend the last number of weeks. But obviously the geopolitical issues around what may or may not be happening in the Middle East remains an issue. And all those things I think are kind of coming together to really cause a bit more of an uncertain market here and outlook over the summer. And then I would say even maybe equal to any of those or maybe more is the upcoming Fed decision, of course, and new chair Warsh, who will be obviously chairing that meeting for the first time under his new tenure. And there's clearly, from my discussions with markets, with market participants, a very disparate, wide tail of both left tail and right tail outlook about what may or may not happen at that meeting. Some people think that Mr. Warsh will be quite dovish and need to be kind of in line with the administration's views. Others believe that he might come out quite hawkish given the underlying strength in the US economy, labor data, inflation, AI capex spending, and effectively need to at least set the table for rate hikes later this year. And I think that uncertainty and on all those things, those 4 or 5 subjects all coming together really are setting us up here as we speak kind of on June 10th after the Bank of Canada meeting for probably some increased volatility across asset classes over, I would say, the next number of weeks, at least, if not month, if not the summer. Because I think none of those thematics and uncertainty of those thematics really are going to go away materially, I would say, anytime soon. And I think that uncertainty and the culmination or stacking of all those thematics on top of each other, I think can make for a pretty tricky, higher vol market here over the next little bit. So what do you do when you're kind of in a high volatility environment? Generally speaking, not always, but people are generally moving away from what we would call high beta assets. So very growthy names, things that you would buy in a very risk on environment and rotate a little bit more towards an environment that maybe you'd be looking for lower beta names. And just putting on kind of my day-to-day, week-to-week hat for a second on the fixed income team, one would say, okay, well, that's probably a pretty good environment for fixed income and buying duration, prices higher, yields lower. And that could be the case. But again, one of the big drivers here clearly is, I think, higher for longer inflation, driven by higher for longer energy complex, and which probably means a higher for longer term structure of interest rates. And so, on the team, we've been kind of shying away from buying, I would say, in particular, US nominal duration. So buying treasuries, prices higher, yields lower. Because we don't think that that is really where the direction of travel is here for the next little bit. So again, kind of coming back to my comments and not to repeat, but it is a bit of an odd environment from that perspective. One would think that in these periods of high volatility, you may want to be owning fixed income and being longer duration and kind of shunning kind of the higher growthy names. But, with obviously a lot of concentration within the equity space, particularly in the US, and earnings looking quite strong so far year to date, and the earnings picture for 27 also looking pretty decent. Maybe the most dangerous words in finance, but is this time different? And is the market not necessarily going to be looking for shelter within a fixed income environment? So I think that's very interesting from the things that I'm looking at. I don't expect any major resolution in the Middle East anytime soon, Yes, oil has come off pretty significantly. We traded 126 in Brent. We traded 91, 92 earlier today. That's obviously very important. We've seen kind of the short-term inflation market, the CPI swap market, both the 1 year as well as the 1 year, which is effectively what is 1 year inflation going to be in a year's time. Both of those metrics were looking quite frothy a few weeks ago, have now come off. Maybe again, not surprising given the move in oil from around 125 down below 95. But I don't think that we're going to see oil get to levels that were pre hostility. And on a year over year basis, we are clearly seeing an uptick in inflation. We had the US inflation numbers this morning as well. Again, fresh high on an annual basis for the cycle. A lot of that is getting powered by energy, no surprise. But we're also seeing a lot in what people call supercore, and we're seeing a lot in terms of services inflation, even if goods inflation is actually coming in pretty weak, and on the monthly actually came in actually negative month over month. So net here, I think where we want to be is for the next little bit, kind of shying away from higher vol assets, unless you're a vol trader and you want to be long vol. I think you want to be cautious, but obviously still have risk on the table. We generally prefer real yields and break evens over nominal duration from a fixed income perspective. And I still think the dollar has a fair bit to rally here, US dollar, over the next little bit. Bank of Canada today, I think, was very interesting, even though there was not a ton of change in the official statement from the previous meeting, which of course was back from April. Today's meeting, obviously the June meeting was not a forecast meeting. So April was, we had the MPR, the updated forecast round. But today, the June meeting did not. So really just stuck with the statement itself and of course the press conference that happens at every meeting. Much of the last two paragraphs in the formal statement were very, very similar to where the bank left us in April. So we didn't really move the ball too much. The bank is still, I would say, unsure overall. And so doing nothing, or at least not making any significant moves, is probably one of the reasons why, if not the main reason why, the bank decided to leave rates unchanged at 2.25%. The bank is still concerned that we could see upside inflation risk in Canada based on obviously not only the higher energy complex from the hostilities in the Middle East, but also kind of second and third round impacts. And to be fair, the bank has said, well, it's not enough just to see a supply side shock to get us to raise rates or hike rates. It would need to see those second round and third round impacts for the bank to actually start hiking rates. And it seems to want to look through the quote unquote temporary nature of the hostilities in the Middle East, and probably one of the reasons why the bank has refrained from hiking rates so far. But like the bank said at the last meeting, at the April meeting around USMCA and the renewal of USMCA, having elevated it at the April meeting as a risk for potentially cutting rates later this year or at some point in the cycle, the bank and Governor Macklem also highlighted the same today, suggesting that nothing happening on USMCA is potentially a downside risk for the economy and potentially a rationale to cut rates. Obviously, the calendar has moved from April to where we are now in June, getting a little bit closer to the July 1st date. It looks very obvious now, listening to just what the U.S. Trade Representative, USTR Greer, has said. July 1st looks like that day will come and go with no agreement, and they will continue to have discussions, Canada, US, and Mexico. I continue to be concerned about the outlook for USMCA with respect to Canada. I do think that the US administration, USTR, is not particularly thrilled with some of the deals that Canada has made, and it could cause some problems and some stickiness in terms of getting a new deal done. We've been focused a lot, and I've talked a few times on a few of these podcasts about rules of origin requirements, ROO, particularly for autos, and particularly parts for autos that come from Southeast Asia and China. Trump in the last week or two has said that he wants to have 50% of the components of any car sold in the US manufactured in the US. And that is a very big deviation from the North American standard under NAFTA or what is now USMCA. And I feel that that's going to be a pretty big sticking point. And if there has to be some movement by Canada on that to save the deal, I think it's going to be pretty significant for the country overall, absolutely, but certainly certain regions of the country. Ontario obviously comes to mind from that perspective. So I continue to be a little bit more bearish, let's say, on USMCA getting done, however you want to define done. And I think we saw that a little bit in the Q1 GDP data, which has been out since the last time we had this podcast, with fixed business investment looking pretty weak. And I think that the risk of that happening and continuing, fixed business investment being weak throughout 2026, is quite large. So we continue to have a out of consensus view for Bank of Canada outlook. I continue to believe that the Bank of Canada can cut this year. Market continues to price a hike. Last time I looked, which was about an hour ago before starting the podcast, but after the Bank of Canada meeting this morning, the market was pricing about 27 basis points for Bank of Canada hikes by the end of the year. But I actually think that the bank can cut. Again, one of the reasons behind that is because I'm probably more bearish than most on the USMCA outlook, but also the population decline in Canada, the labor market, not last Friday's labor force survey, strong data withstanding the housing market reset. And all those things, I think, are not necessarily constructive here for the Bank of Canada and for the underlying macroeconomic outlook. So I do think that the bank can cut. Originally last year, and we talked about the bank cutting this year, I'd focused on June. So this was the June meeting, came and went. Obviously, that did not happen. And then we focused on July. It probably will not be July at this point. It's probably well into the second half of the year if the bank decides to cut rates. Obviously, if the Fed starts hiking rates at some point later this year, that will also probably, all other things equal, make it a little bit more complicated for the bank to be cutting rates. But it's not impossible. We can see the central banks between the US and Canada diverge, with the Fed hiking and the Bank of Canada cutting rates. Continue to be relatively cyclically bearish on the Canadian dollar here, and not surprisingly, given kind of that general outlook in terms of interest rate differential, particularly on the Canadian side. And of course, if USMCA doesn't come together particularly well, also probably not going to be great for the Canadian dollar. So continue to look for, as we call it in the market, dollar Canada to move higher, maybe towards 140 or even 141, as opposed to back down to 136. Those are the main thoughts I wanted to get across today. Again, thanks very much for your listenership, and we'll be back soon with some thoughts around the Federal Reserve meeting and Chair Warsh's first attempt at press conference. Until then, thanks very much for listening and have a great week. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.